So I'm going to redo this video. I had a little trouble uploading the previous version of it, even on YouTube. So this is, I want to go through some of the material on a trade war, and this is, it really precedes Trump to some extent, that ever since the 2008 global financial crisis, and even before that, if you think about after the Asian crisis, we've had a movement around the world really towards putting more restrictions on trade and more restrictions on financial flows. So in some respects, I think the period of high globalization was in the 1990s, and then we moved to it's not quite post-globalization because there's still a very interconnected world, but one in which countries were looking to put more restrictions on trade, more restrictions on finance, and that accelerated after 2008. So I want to go through some of the material of these waves that take place and look at protectionism and some of the thoughts that economists have on this. I think economists in general, what I'll say about trade just up front is that I think we probably overstate the benefits of allocative benefits of trade. What I mean by that is that we get cheaper goods here and more productivity there, those sorts of things. I think the real benefit of trade has to do with the long-run transformative powers of trade on a society, and that has to do with ideas. It has to do with the pressure to compete, and it has to do with opening up a whole new avenues of things. So, excuse me. I think that economists both overstate and really understate the power of trade. I think it's one of the most transformative forces in history. It really destroys whole industries, creates whole new ones. I think it's an extraordinarily powerful vehicle for transformation. On the other hand, I think it's not so simple as the theory of comparative advantage. That's not the only aspect that's going on. There's more to it than that. I also think that sometimes protectionism can work in small doses. I don't think it works very well when a society turns inward. But it has worked well for some societies that have turned outward and used some protectionist methods to turn outward. So the real issue is not protectionism versus non-protectionism to me, but inward versus outward orientation. So let's, I put the Costco carts up there because just recently we were banning the movement of these things because they were involved in some of the acts that Iran was doing, and so. But these are containers, and I mean, they're one of the most important things when we're thinking about globalization is this ability to containerize. So let's work down some of this stuff. So what are the reasons for the trade war? Why are we even considering putting more tariffs in place? And I think the driving force for this is what's known as our balance on our current account. It's probably easiest to think of this as our trade balance. So exports minus imports. When this goes negative, we're importing more than we're exporting. We have done this for the most part since the 1980s. And even before that, we were doing it some, but it sort of explodes during the 1980s. And then you can see a recovery there in the global financial crisis. That's nothing good in the economy in some respects. What's happening there is we're simply, our incomes go down, so we don't buy as many foreign goods, so that improves our trade balance on this. But you can think of the current account as the trade balance plus some bells and whistles in there. Net investment income and some other accounts that are on there. I'll talk about that a little bit more when we get into currencies at the end of the class. For now, just think of it as our trade balance. And you can see we've been negative during this entire period. Significant portion of this is with China, and you can see that that's gotten even more negative. And actually, since the trade war took place, it has not improved very much. It's actually gotten a little bit worse on that. It kind of goes up and down based on states of the two economies and movements in exchange rates and things like that. But this is where it comes from. I mean, I think President Trump views this as we're getting taken here. And there are two ways of looking at this. One of them is that we're getting more goods than we are sending abroad. Or we can look at it as other countries are taking money from us on this. I think that's the two ways to sort of look at this. On the other hand, they're holding money, but they're giving us goods. So economists are, for the most part, don't worry too much about the trade balance. However, there is a debate in the field on that. But I think it's not so simple as to think that we're getting taken, but there is a little bit of that, idea out there. So we'll examine that in further detail on that. So that's the first thing, is this current account deficit has mostly been negative, and sometimes severely negative on that. Second reason is you've seen some of the supply and demand questions that talk about Chinese subsidies. So often subsidies aren't thought of as protectionism, but they have a similar effect in that they make a domestic industry more competitive vis-a-vis foreign industries. In fact, it might even be a better way in the essence, in the sense that it doesn't raise costs to consumers. In fact, it probably lowers costs to consumers to have these subsidies in place, although the government has to pay out these subsidies in one form or another. And then there's the issue of dumping. This is when a country puts stuff on the market, on the global market at below cost to try to garner market share. And certainly some of this has gone on. We made the same accusations against Japan in the 1980s. And so this is another concern that's out there. But I think the real big one is the fourth one down there, the TRIPS, the trade-related aspects of intellectual property rights. These are patents and other ideas or products that we've that are out there that we developed, and the accusation is that China has stolen these. This is a tried and true method of developing, is to steal technology of one sort or another. We did it with the cotton gin, and it's been a tried and true method over a very long period of time. And so when we look at this, this is probably, I think this is the biggest issue, and it's a significant issue, as is some related things about how China treats some of our foreign businesses. And so I think those are all significant issues. And so there is a reason for certainly negotiations, and certainly trying to put some pressure on China over these issues. And the last one is the renminbi, which is the Chinese currency. And there is a thought that they've been manipulating their currency. I think any country that has a central bank manipulates its currency. That's what a central bank is doing. So the accusation is certainly true, but we are too. That's what the Federal Reserve is doing, is manipulating our currency. But the question is whether or not they were using it to undercut foreign competition. To me, this is the most effective way of competing, although it can be inflationary. But countries that have done this have a pretty good track record on it. So I think this is a significant concern. On the other hand, I don't think it's actually something they've been doing recently. I think it's something that they did for a long time. And I'll go through that now, and I'll come back to it a little bit when we talk about currencies. So let's talk about this renminbi. What you're looking at here is the exchange rate between China's currency and ours. So when this is how many won or renminbi it takes to purchase a dollar. So when this ratio goes up, you're getting a stronger dollar and a weaker renminbi. And then when it comes down, you're getting a weaker dollar and a stronger renminbi. So you can see China's been, it's had the biggest 30-year growth spurt of any country in history on that. And they did it through lots of things, lots of liberalization, lots of productivity gains. But one big one was what they did with their currency. And you can see it right here. That if we go way back to the 1980s, you're looking at somewhere between 1 and 2 renminbi to a dollar. And then if you get up there in the mid 1990s, you're at about 8.5 renminbi to a dollar. And just think about that. That what that's doing is making their goods extraordinarily cheap, just simply on dollar terms. So even if prices didn't change at all in China's currency, they're getting extraordinarily cheap in terms of dollars because of that movement that's happening there. And then you can see they fixed the currency against the US dollar. Actually was fixed to a basket of currencies, but and they didn't really publish exactly what the ratio was, but you're looking at, you know, somewhere in the order of 87 to 93% tied to the dollar in one form or another. So essentially it was tied to the dollar. And then they broke that fixed currency as we get into the mid 2000s. And then at that point, the Chinese currency actually generally has gotten stronger. And then as we get into the late 2010s, it starts to weaken again, but not, you know, not dramatically, but starts to weaken again in that period. And so the criticism is now, I suspect that the criticism was valid back in the 1980s and 1990s, and probably a little less so today. I sometimes wonder if they were to allow their currency to totally move, that it wouldn't get weaker rather than stronger. And what we would probably want is for it to get stronger. So that it's the question of manipulation is less clear today than it was back then. And just so you understand how this operates, again, this is a market situation. So if something's being fixed, something else has to be being altered. And what was altered is they ended up holding tremendous amounts of dollars. These are dollar reserves. The dollar is known as a reserve currency. And China just held tremendous amounts of dollars. So they did that, and this will become clearer when we get into exchange rates, but I'll explain it briefly now, is that, you know, normally when, if we bought more from China than they bought from us, they would have to turn around and buy stuff from us. So they have three choices. They can take the proceeds from those sales to us, buy our goods, or they can turn around and loan us the money, which they did quite a bit of that as well, or they can just sit on it, which they did to the tune of about $4 trillion, if you look at that. So this is either the most ingenious move in history because they're holding on to, they've garnered all this amount of dollars for future use, or it's the worst bet in history because if the dollar loses tremendous amounts of value, they've just given us all types of a whole bunch of goods for an asset that might lose value over time. So it depends how you look at it and try to decipher that. And probably the truth is somewhere between those two. But what they did is instead of turning around, I actually should have said there's a fourth option. They could let their currency get strong against the US dollar. And they were trying to keep that from happening. So they just increased the demand for dollar. So if we think about a supply and demand for the dollar, when we buy their goods, that increases the supply of dollars. And so just like anything else, if there's an increased supply, then the price should come down. The price would be the value of the dollar in this case. On the other hand, because they bought all these up, they hang on to them, they increase the value of the dollar, thereby weakening the renminbi on that. And they hung on to these things. You can see they've unwound that a little bit in recent years, but they're still holding quite a few dollars that are out there and dollar assets. It's kind of interesting when you look at the Bank of China. Our central bank, the Federal Reserve, is holding mostly, well, mortgage-backed securities these days, but mostly U.S. government debt. The Chinese central bank is holding a lot of U.S. government debt, so it's interesting that their central bank is actually holding the same thing as our central bank. That's why sometimes I wonder if it's really an independent central bank on that. So that's looking at the currency issue, and that one I think is a mixed on that, but it's certainly one that was very significant in the past to this garnering and this trade deficit that's out there. Now, one thing is, this is looking at the volume of goods and services traded. Whoops, excuse me. It's looking at the volume of goods and services traded, and you can see that we go through fairly significant cycles over time, that the volume goes up and down, usually goes down in recessions. It goes down because of sort of waves of protectionism that are taking place, but it does fluctuate all around on that. And then one thing we've seen is, if we're thinking about, this is world trade as a percentage of GDP, and this is, you can see the massive expansion during the 1990s. So again, that GDP is our measure of output. So as this is rising, trade is taking up a bigger proportion of GDP. And you can see how that's stagnated. And really, since that 2008 crisis, it's really hasn't grown at all, and actually declined in the mid 2010s or so. And so we really have had trade amongst the world go retrograde. And there was a period in 2015 where the value of trade took a huge hit, and there just wasn't things being shipped as much. And so that you can see that in the data there, and we've never quite recovered from that. So this all precedes this so-called trade war on that. So this is a trend that's more global in its orientation, and not just between the US and China on that. Now, economists always worry about trade wars because they harken back to the 1930s. So this is a diagram from Ronald McKinnon. It's one of the more famous diagrams in economics. But this is this shows the spiral of world trade that took place going into the Great Depression. This is both because there was a decline in the state economies, but also there was increased protectionist walls. So you can see trade in the beginning of 1929 was about $3 billion. These are in billions, so about 2.9, just about $3 billion. And over the next few years, as a spiral of declining economies, retaliatory tariffs going back and forth, starting with the U.S. Smoot-Hawley tariff, and then just spreading around the world in one sort or another, you saw this decline in world trade down to about 1/3 of what it had been in 1933 versus 1929. So that was a massive decline in world trade. McKinnon argues this was a contributing factor to the Great Depression. It was particularly bad for the U.S. because we were still on a gold standard, and so we didn't devalue our currency. And not only was there sort of protectionist walls being put up, but there were sort of competitive devaluations, weakening of currencies around the world. So this is what happened in that period, okay? And that's one that, economists will always bring up again and again and again on this, okay? So we have had a period of, if you look at the post-war period, and I'm going to get out of full screen because I'm not sure you can see the dates on that. So I'm going to move on to that. When you look at this, this is looking at where tariff levels are. And just remember that a tariff is usually a tax on imports, though in the 19th century we had a lot of tariffs on exports, trying to keep primary goods in the US. Today we usually think about tariffs as keeping out foreign goods, or at least making domestic industries more competitive with those foreign firms. So generally speaking, there was a period of, if we think about pre-Civil War, the South generally didn't want tariffs because they wanted to be able to export cotton and goods like that to the highest bidder, essentially thinking about Britain. And the North wanted tariffs to protect the manufacturing industry. So, which was competing directly with Britain and other European powers. So once the Civil War takes place and the North is victorious in that, then you have this long period of protectionism. And it isn't until the Wilson administration that you really get this movement down in tariffs by something called most favored nation status. And this means that when I get an agreement with one of my major trading partners, one of the countries figured in the most favored nation, then this will extend to all the countries that also have most favored nation status. So this is a big drop in tariffs. And then as we were approaching sort of a period of depression, there was the raising of tariffs again up in that Smoot-Hawley tariff, and this reversed things. And then after World War II, there's this long period of lowering tariff barriers. Now, one of the problems with this, and you can see the rounds in the GATT, which is the precursor to the World Trade Organization, the General Agreement on Tariffs and Trade, that comes out of the Bretton Woods institutions in 1944. And this is a long period of lowering tariffs. And this goes, I think, lowering tariffs goes generally up until the 2003 period, when developing nations walked out of the Cancun negotiations of the World Trade Organization over the issue of non-tariff barriers, NTBs. These are, so we can think of protection as tariffs, but there's lots of other barriers to trade out there, regulations, quotas, other vehicles on that to inhibit trade in one form or another. And one of the things they were arguing is that, yes, we were lowering tariffs, which is the primary tool of more developing countries, but we weren't lowering those other tools, particularly agricultural subsidies and things that more developed countries used. So that's been that issue has been a dividing line ever since on that. But you can see the period tariffs came down dramatically, but as we get into the 1990s, non-tariff barriers start to increase on that. But we do have this period in here where we see that the volume of exports far exceeds the growth of GDP. And so this is a world that's in the post-World War II era that is much more open to trade on that. So let's look a little bit at the benefits of trade. There's lots of them, but sort of the big four that I think of are increased variety of goods. So there's lots of stuff we couldn't get without international trade. It should lower costs, both, as the video showed you from the marginal university, both through allocating things and through these economies of scale. Economies of scale mean that as you do more of something, your efficiency increases, or you can think of it as you increase production, as you increase inputs, you more than increase outputs. That might be the easiest way to sort of explain economies of scale. The bigger gets you efficiency gains, so specialization gets you efficiency gains. It also provides increased competition, which drives down prices and probably increases quality, and all those sorts of things that are out there. And the big one for me is the enhanced flow of ideas, spread of technology, just sort of thinking differently. And I think all of these are important in their own right on that. And another reason that economists tend to be free trade beyond the sort of logical idea of comparative advantage is simply that historically, those countries that have turned inward have done more poorly than those countries that have turned outward. And there's sort of a distinction between thinking about what happened in Latin America, and this is a very simplification, but just to do it quickly right now, we can talk about it more if you'd like. But as Latin America turned inward, East Asia turned outward. And it isn't that they were laissez-faire, leave it alone, or totally free trade, but they certainly turned outward, whereas a lot of Latin America turned inward with a policy called import substitution. And so what this did is that in the 70s and 80s and into the 1990s, East Asia grew much faster than Latin America. In fact, the 1980s were very tough on Latin America, sometimes called the last decade. That has to do with the inward turn, but it also has to do with the debt crisis that ensued. And the debt crisis was made worse by countries that weren't generating enough foreign exchange, enough ability to pay off those debts that they had on that. So we can sort of look at the growth rates of the two regions. This is looking at Latin America, and you can see the 1980s were a very difficult period they're a period that followed a long period of sort of turning inward. So some countries had achieved fast growth rates before that, but then they fell on hard times in the 1980s. I would probably say that another contributing factor, just to complicate the picture a little bit, is that the Federal Reserve raised interest rates in the early 1980s, and this was felt, given that idea that the Fed is really a central bank to the world. You can see some of the ramifications here. The thing is, if you look at East Asia, these are their growth rates. If you want to know, these are geometric means. That's how I calculated them. So they're year-on-year growth rates, but they're geometric means going up. And so you can see just how fast the growth rates were in East Asia. And they continued on in the 1980s or so. So this is another argument that economists use for thinking about why expanded trade is beneficial. So we have a logical argument. We also have kind of an historical argument on that. Now, there are some implications from trade. So as we're looking at this, one, specialization occurs. Now, that is both beneficial, but it also means it reduces the variety of goods that they're going to produce. So countries might be more susceptible to shocks because suppose that trade makes you focus on some commodity like soybeans, and less on a variety of goods you're producing. If there's a huge change in the price of soybeans, then you're going to have problems, and you're going to be hit quite dramatically. I know that when I look at the history of Ghana, which is often, they export cocoa and a few other export crops, and boy, the state of their economy for decades was really governed by the prices of cocoa. And so that's one of the difficulties with focusing on trade so much. Reduced prices for these commodities. Raul Prebisch in the 1970s tried to show that the long-term pattern of primary exporters was a declining terms of trade. And so they would, over time, their trade situation would get worse as what they were exporting would be worth less and less of what they were importing on that. So there's job creation and destruction. There's no question to me, this is, it's not all job destruction and not all job creation, there's both. That it, Joseph Schumpeter had the term creative destruction, and I think trade is very much creative destruction. It destroys whole industries, creates whole new ones. I think about the North American Free Trade Agreement, really destroyed the Mexican corn industry, had a hard time competing with US agriculture. On the other hand, it created an auto industry in León, Mexico, and so I think those are flip sides of trade. They're on that. In some of the industrialized countries, it causes deindustrialization because some of these manufacturing jobs are shipped elsewhere, and so this is of concern. And then the last one, and then I'm going to switch to a second video so I can make sure I upload these. I'm having some issues these days, even through YouTube. The wage effects, this is something called factor price equalization. And I'll talk about this a little bit more when I get into the Heckscher-Lean model, but the idea is this, that as trade goes, if you have a lot of labor and I have a lot of capital, that when we open up to trade, my comparative advantage is going to be based on capital-intensive industries, and yours is going to be based on labor-intensive industries. So it'll increase the demand for labor-intensive industries in your country and increase the demand for capital-intensive industries in my country. So that should increase the return on capital-intensive industries and decrease the return of wage-intensive industries. So it should put downward pressure on wages in my country and upward pressure on wages in your country. This is called factor price equalization. And there does seem to be some evidence of this, but it's actually more common amongst similar countries that are trading with each other than really diverse countries. In other words, we do see convergence in wages in places like Europe. that take place on that. But there is some of this that goes on. So I think it's a significant, and Krugman's section on this talks about this, and I think he does a very good job. So I urge you to read that section on trade and wages, because I think he explains things really well, and he's done a lot of research on that. So he's a good person to read on that. Krugman and Wells, I should talk about Wells as well on that. Okay, I'm going to pause here and come back so that I can make this in more separable areas on this.